Hi there, welcome to Kneppy Invest. I had planned on doing another video today, but it is the 4th of July. And because I did live in the United States for 8 years and I do have a United States citizenship, I thought it'd be great to do a technical update to celebrate 4th of July. And I'll be looking at the Nasdaq, S&P 500, Dow Jones, just the indexes. And then I'll have a look at some individual companies in regards to what the technicals are showing us. So if you don't like looking at charts, this is probably not the video for you. But one of the other reasons I am doing this is I am starting or have begun to draw up a watch list of companies, not only in Australia, but also United States, that I do want to own, particularly if we see further significant downside in the markets. First index I want to look at is the Nasdaq, the NDQ. This goes back to 1985, and this is the monthly linear chart. Now, typically, I do like to look at linear charts, particularly in the short to medium term. So we're talking about 10 years or so. I prefer to look at linear charts. Once I extend the time frame, says, hey, 30, 40, 50, 100 years, definitely log charts are preferable because the markets go up, say, 7 to 10% per year. And if you just looked at linear charts, you won't be able to see that increase 7 to 10% per year. So you can just see here with the linear chart for the Nasdaq going back to 1985, there were periods here where the chart or the Nasdaq has risen exponentially. And you sort of want to wash out that exponential rise in the log chart because it should be rising exponentially if it's rising that 7 to 10% per year. So if you look at the log chart, you definitely can see how that the perspective totally changes, and you get a really good trend here with the NDQ going back to 1985. And I've portrayed that uptrend with that sloping upwards dashed line. And we have not seen the NDQ go below that dashed line, hence the uptrend. We have seen it hit 4 times since 1985. The most recent time was during the GFC. Even during the tech bubble burst, it didn't quite hit the uptrend line. It fell a little bit short. But also, the other thing I've included here is the moving averages. And then the markets go up through time. And this is perfectly portrayed by the moving averages. The 50-month moving average has always been above the 100-month moving average. And this is an indication that the markets are always rising. Now, the Nasdaq has been under pressure over the past 6 to 9 months, but it's just a little bit of a blip on the overall scheme of things. So everyone is running for the hills, it seems like. Everyone is maybe not panicking, but we haven't seen a major correction in the market based off this particular chart. Now, in the worst case scenario, and this is the worst case scenario, there is a possibility the Nasdaq might move towards about 4,100. That is the uptrend line. And if we do move towards that, I would be going and investing all in. I'd probably be going to debt to invest more. I think hitting the long-term trend over the next 1 year, probably be in the next year or so. I think it's a low probability scenario, but it's not out of the realms of possibility. So the future is all about probabilities, and you have to look at the risk of all these probabilities happening. The Nasdaq going to 4,100 is a possibility, but not a probable scenario at play. So I do think there is a possible scenario where we do move towards about 8,000, 7,000, that scenario. But just look at the overall macro environment and things really hit the fan. That's when we might see the Nasdaq fall away to the upwards trend line. If we do have a look at the daily chart, we'll get rid of the log chart. So you can just see here. So this is the log chart, just looking at the daily over the past almost 2 years. And when you actually look at the linear chart, there is no difference. This is why I prefer to look at linears in a short term, say 5 to 10 years, but look at the log charts when we're looking the longer term. So if we turn attention to the daily chart, the Nasdaq is in a downtrend. There is no arguing that right now. If we go back to 2020, 2021, we were in the buy the dip situations, and we had quite a few buy the dips in the Nasdaq, about 5 or 6 during 2020, 2021. But right now, it's actually sell the rally. Every time the Nasdaq climbs a little bit, we do see some selling and do see some distribution of institutions selling some shares into those rallies. No idea where the bottom might be reached. No one has any idea. There's a lot of bulls and bears out there right now. I think it was Roger Montgomery said, we must be reaching the bottom right now because he doesn't know anyone who is bullish. I actually disagree with that. I still know quite a few people who are bullish. They think these are great times to buy right now. So I think the best time to buy is when there's absolute pessimism out there. And I think if that does happen, we would be in a recession, and peak recession, peak pessimism is the best time to buy. So let's have a look at the Dow Jones. And the reason I want to look at this Dow Jones index goes back to something like 1897. So we look at the lug chart here again and look at the monthly. And because we have a very long time period here, a lot of data points here, looking at monthly charts. So we're all the way back. So the trend is up. The Dow Jones is up. Indexes rise with time. The equity markets rise with time. This is why you invest, because it rises through time. Best performing asset class out there, without doubt. And instead of having a trend line like I did with the Nasdaq, what I've got here is sort of an average line. So reversion to the mean is something you might hear on occasion. Now, this dashed line isn't exactly sort of the average or median, but sort of what you could expect over time. And there have been periods where the Dow Jones has been below it, but it's been pretty rare it's been below it. And there's been long periods of time where it has been below it. So, for instance, during the Great Depression, it went from being significantly above the long-term, say, average line to be significantly below it, and then remain below for the next 15 to 20 years. You might actually hear on occasion people say it took something like 20, 30 years for the Dow Jones to recover to pre-Great Depression highs. And that's definitely true. And then we also saw the Dow Jones below the average during the 1970s inflation period. The Dow Jones actually went sideways for about a 15-year period. And then we started to see the Dow Jones go up as we started to see interest rates fall. And we've seen 40 years of falling interest rates. And that could be coming to an end. And we actually have seen the Dow Jones be above that average line since 1988. There is a possibility we might go below it if we get a long period of stagflation. That's a possibility. No, I don't think that's a absolutely likely scenario, but a definite possibility, a long period of stagflation. There are so many scenarios or possible scenarios for the economies in the world over the next 5 years, but I have no idea what's going to happen. No one has any idea what's going to happen. Even the experts have absolutely no idea. And when I say experts, I'm talking about the central banks around the world, the governments around the world have no idea what's going to happen over the next 5 years. But again, the main thing with the Dow Jones, if we look at the daily chart, it's in a downtrend. Not quite as bad as the Nasdaq, but if you actually take a line, let's draw the pre-COVID highs here. So if you draw a line from the pre-COVID highs, which is right on 29,600, we have seen the Nasdaq bounce off the pre-COVID highs. So we do probably describe that level, 29,600, as a really good support level right now because it has bounced off it and it was the pre-COVID highs. And the COVID lows, COVID-19 lows, are well down, just above 18,000. So a lot to fall from there. But definitely right now, Dow Jones is in a downtrend and we have no idea where the downtrend is going to end. Now let's have a look at looks like the S&P 500. Should we have a look at the log? Let's have a look at the log. Actually, that was a log. And look at the monthly. Yeah, so one of the interesting things about, actually, I'm going to look at the non-log. I reckon, so when you have a look at the non-log, the monthly, the one thing you'll notice here is when you look at the monthly, so this is looking at 50 and 100-month moving averages. So 50 is 4 years, 100 is 8 years. And there is not one single period of time, this goes back to 1950s, there is not one single point in time when the 50-week moving average, or 50-month moving average, went below the 100-month moving. There is very close in 2010. But ever since the start of this period, 1950s, the 50-week or 50-month moving average has been above the 100-month moving average. So you could say, again, this is showing you that over time, markets go up. And this is one of the reasons why people say you should be always fully invested, because you can't time markets. The markets rise with time, so stay fully invested. And this is probably true also for the Nasdaq. If you look at the monthly, if you look at the monthly again, the linear, the monthly, 50 monthly has not been below the 100 monthly. And I'd say that's same for the Dow Jones as well. So this is the Dow Jones. I'm going to try to find a time during history. Very close. Here it is. During the 1980s or 70s, we had one little period here where the 100-week moving average was above the 50-month moving average. And you just see the Dow Jones during that period was just going sideways. And that was because of inflation. If we go back further, yes. So there was one period during history where the 50-month moving average fell below the 100 moving average with the Dow Jones. And that was around the Great Depression times. And then it did recover quite gradually over the next 10 to 15 years. So probably the main story here is over time, the equity market does rise. So that's why investing in the equity market is probably the way to go. It's my preferred way to invest. The other reason why I like to invest in equity markets is simply because it's highly liquid. I definitely prefer it over property. Property, again, also rises over time, but the yields in property right now are probably pretty stupid. Anyway, let's have a look at some individual companies. And I'll go through this fairly quickly, I think. And we don't want to look at monthlies. I think I want to look at weeklies now. And first company I want to look at is PayPal. And this is the first company I invested in because I do see some value here with this company. And we have seen PayPal fall from $310 to a current share price of $71.40. The horizontal lines, dashed lines here are support levels or resistance levels. It has fallen through the COVID-19 financial panic lows, which were around or just under $90. And now it's hovering right on another nice little support level at $70. The next support level for PayPal is around $45. And that was a support level we saw reached back in 2016. When you do look at some of the financials for this company, PE ratio 23. But one of the things I do look for in companies to invest is rising revenue. Revenue is definitely rising. Even if you look at the quarterly data, it is gradually rising. So I do think there is some value with PayPal right now, particularly because it's fallen. And I think there is some good value. When you look at some of the valuation metrics for PayPal compared to historical levels, this is probably the cheapest this company has been over the last 6 or 7 years. MercadolIbre, this is a company I've been focusing on. So fairly similar to Amazon, but in the Latin American markets. So it's mostly Brazil, if I remember correctly. And we have seen MercadolIbre fall from 2000 to current share price of $659. It has fallen just below the COVID-19 or pre-COVID-19 highs, but still is above the COVID-19 lows, which is around about, or just around $440. When you look at the valuation, market cap of $33 billion, rising revenue again. So look at the annual, really good rising revenue. So revenues increased from $1.2 billion in 2017 to $7 billion in 2021. But at times it has not been profitable. So that's the main concern with MercadolIbre. They've concentrated on increasing revenue and not really concentrated on increasing profits. Probably say there's probably got some good cash flow. So cash flow, almost $1 billion of cash flow over the past few years. So you could use that and probably argue that this company is looking much better value. So definitely growth when you look at revenue. And I think we are heading towards some good value when it comes to MercadolIbre. Shopify is another company that has fallen right onto its COVID-19 lows. This is why this company is interesting to me. Good growth in Shopify. Look at the revenue has grown from 670 million to 4.6 billion in 5 years. It says that net income or profit for last year was 2.9 billion. Use that or take that with a grain of salt. When you look at quarterly data, we have seen the company lose 1.5 billion in the most recent quarter, with revenue at about 1.2 billion. The revenue has fallen the last few quarters, and I think the reason why the share price of this company has fallen is because the market is expecting this company and a few other companies like it, like Amazon, MercadolIbre, Kogan, those companies to suffer for many reasons. And one of the reasons is because potentially we are moving into recession, less spending, and hence these companies will suffer. But long-term thematics behind these sort of companies are still there. Those tailwinds are still there. And I think now could be a good time to start thinking about buying into these companies, particularly because share price of Shopify has decreased from $170 to current share price of 31. So share price has fallen a lot. We're starting to see increasing volume. So there are participants in the market becoming more interested in Shopify. Amazon, high quality company, another company that could be affected by decreasing spending, that sort of thing. But the reason I'd probably invest in Amazon is because of Amazon Web Services, and that's not going to really be significantly affected by any sort of recession. We'll see small effects, but nothing significant. Share price of Amazon has been hovering around pre-COVID highs. So if we actually look at the daily chart with Amazon, you just see it hovering around. That's that dashed line. That's the pre-COVID lines. It's been, going up and down below that line over the past few weeks. In fact, over the past 2 months. If we look at some other daily charts, go back to PayPal, MercadolIbre. No, I think it was Shopify. You can see, Shopify. You can see Shopify, that was that next support level, fell through the support level at 55. But we have another strong support level just above $30. And Shopify has tested that support level about 3 or 4 times in the past 2 months, and it has not fallen through it. And Shopify right now is right on that support level. So the next few weeks is very important for Shopify. If we see the share price fall below $30, that will be a fairly bearish sign for the company. And that support level was COVID-19 lows. So I still can't believe that the market is as bearish around Shopify as it was back in March 2020. Back onto Netflix, and we'll look at the weekly chart for Netflix. I don't think I would buy into this company. There's a few reasons. One of the reasons is they don't have much cash flow. So very little free cash flow because they do a lot of capital expenditure, producing more and more shows. I think one of the things I'd love to see Netflix do is to try to increase the amount of quality shows instead of quantity. So I think they should be heading towards quality instead of quantity. That's my own opinion. They've gone down a different road and are all about quantity instead of quality. I think some of the other streaming services are heading more towards the quality over quantity, particularly Disney. They don't produce many shows, but the shows they do produce are really high quality. Anyway, you probably heard about Netflix has seen some significant headwinds over the past few months, past year. Share price reached a high of $700 the end of 2021, and has fallen from $700 to $179.95. The last time a share price of Netflix was this low was way back in 2017. The next support level for Netflix is $131. And the reason that support level, if you go back to 2016, you can see the share price hit $130 and it struggled to get through it for about a year or so. Now, we have seen Netflix in the past be under problems, under stress. And if we go back to 2011, we saw the share price of Netflix fall from $42 to $8. And that was the last time we saw subscribers actually fall. And then the business turned around. We could see that again with Netflix. By this point in time, we have seen the share price just hover or go sideways over the past few months. So it was oversold. And the fact we haven't seen any significant bounce is concerning to me. I like to see proof of a recovery in the company. I like to see the company get more subscribers and before I even think about investing in Netflix. Now on to Google, a company I definitely am thinking of buying into. I think this is a high quality company that is actually looking cheap, even though the share price is significantly higher than even pre-COVID levels. So pre-COVID, the high got to around about 1,500 and share price right now is 2,181. But when you look at some of the financial of this company, its current price to earnings is 19.78. You don't usually see the price to earnings of this company that low. But I think the market is concerned around the fact that the majority of revenue that Google derives the majority of revenue that Google sees the majority of their revenue derived from advertising. During recessions, most companies start to pare back their spending on advertising and marketing. That's one of the things a lot of companies do. So the market might be concerned that Google might see decrease in companies advertising on Google. I'm not sure about that. I think Google might still see some really good growth in revenue. This company continues to grow revenue year on year. It's a beautifully run company. Lots in the pipelines as well. A lot of things going on for this company. We did see a decrease in revenue from the last quarter to the most recent quarter. So quarter 4, 2021 to quarter 1, we did see a decrease in revenue, but that's just one-off. We have to see that trend continuing. So definitely a company I'm interested in, but at this point in time, the chart, when you look at the daily chart, it's in a downtrend. It has moved into a downtrend over the past few months. Nividia is another company that's on my watch lists. And just like most other companies, this is in a short-term downtrend. As you can see by the daily chart, it is moving down. It continues to fall. In fact, the most recent trading day, it has moved to an over 1-year low, so 12-month low for Nividia. The high in the share price of this company was around about $340. Current share price is $145.23. It has fallen a lot. We'll not call this company cheap. So market cap is $363 billion. Price earnings ratio is 41. So when the share price did reach its high of $340, the price to earnings ratio was almost 100. And I still remember thinking, this company is a great quality company, but it's so expensive. So sometimes just buying into a company because it's good quality without looking at value can lead to some troubles. And we've seen that with Nividia over the past, well, almost 6 or 7 months. When you do look at the weekly chart, still a long way to fall before it reaches the 2 support levels I'm looking at, which is pre-COVID highs and also the COVID-19 lows. Pre-COVID highs is around $80 and the COVID lows is around about $48. So a long way to fall until we get to there, but the chart is looking down for Nividia. Tesla. Now, apparently, I've just noticed, no, I didn't just notice, but they released some really bad news on the weekend after trading finished on the Friday. Sales were down for the quarter, and I did hear that that there is a chance the share price of Tesla might drop a fair bit on open, which would be the Tuesday, the 5th of July. So looking out to see how Tesla trades on the 5th of July in America. But when you do look at the weekly chart and compare the share price now to what we saw pre-COVID or during the COVID period, it has a long way to fall till we get back to those levels. So the pre-COVID highs was just under $200, and share price of this company is $681.79. Still, valuation of $706 billion. I would prefer to buy into, say, Volkswagen, maybe even Ford or General Motors. There is people suggesting that Tesla will be overtaken when it comes to electric vehicle sales by Ford, General Motors, Volkswagen, those sort of companies within the next 5 years. Price earnings ratio, 91.4. But when you do look at the growth, over the past, say, 5 years, really good growth in this company. So that is one of the things I'm looking for. Revenue of $53 billion in the last year, profit of $5.5 billion. If the share price does move towards $200, I think this company definitely looks way more interesting. A company I am definitely taking a close interest in is Taiwan Semiconductor Manufacturing, TSM. Share price has moved down from $144 to $77. So share price has almost halved. The market cap, $396 billion. Price to earnings ratio, 17.9. That's the main reason I'm interested in this company. Good growth in this company. Nice, solid year-on-year growth. The most recent year, $56 billion of revenue, $21.4 billion of profit. Really good margin in this company. I think the share price falls to about $60, or even below that towards about $44, which is sort of the range we saw pre-COVID to COVID-19 lows. That would be an awesome buy for this high quality company. Now on to Meta or Facebook. Now this company is under pressure, has been under pressure for a while. So just ignore the price to earnings ratio of 12.2. And the reason you have to ignore that is when you look at the annual data, it looks pretty impressive. Really good growth in revenue, really good growth in income and profits. But then when you turn your attention to the quarterly data, you see a significant drop in revenue from quarter 4 to quarter 1 and a really big drop in profit. That's because of the issues Facebook has had with Google or whatever it is. I'm not really following it too closely, but it really is going to affect this company's profit. One of the reasons I am interested in Meta is simply because of the future. I do think this company has its eye on Meta and Web3, those sort of things. So I think if they do find success in those areas, this is a way more interesting company. Share price has fallen from $300.80 to a current share price of $160. So the share price has halved over the past, I will say, 9 months or so. And the share price is moving towards the COVID-19 lows, which were $140. Another really high quality company is Microsoft. We haven't seen a significant drop in this company's share price. It's fallen from $350 to $259.58. Markup is still just below $2 trillion. Price to earnings ratio 26.8. Historically, we have seen a price to earnings ratio a little bit lower than that, but this is a nice looking chart. Still a long way to go before I'm interested in buying Microsoft. And the reason I probably would not buy Microsoft at this point in time is simply because I still think it's a little bit overvalued, and I'll have to see share price get to about $190 or $200 before I even become interested in this company. But it's been growing really nicely. If we look at the annual data, really nice growth. Revenues increased from $96 billion to $168 billion. Profit from $25 billion to $61.3 billion. But I do think there is potential for some decreases in profit, decreases in revenue over the next few quarters for this company. A high quality company is Apple. There's no doubt about that. Time to buy this company was back in 2016, where the PE ratio was something like 12 or 13. Absolutely ridiculous. Current market cap, $2.3 billion. So this is the highest valued company in the world at this point in time. Price earnings ratio 22.2. Now, I do have some, I won't say I'm concerned, but I'm not sure what future holds for Apple in terms of how much products they do sell. Is it going to be affected by any recession? I'm actually unsure about that, because I don't think people will pare back any purchases of phones and those sort of things if they are under financial stress. I think there's definitely that possibility. At this point in time, I don't think the market is that concerned. We have seen the share price fall from $180 to $138.9, but not a significant fall. So I think definitely I'm going to have this on my watch list. If I see the share price move towards $80, if it moves towards $55, that's when I'll become ultra interested in Apple. Definitely a company to have on your watch list without doubt, in my opinion. That's just my opinion. Next company I have an interest in is Disney, and the share price is under significant pressure, moving towards its COVID-19 lows, which were $85. Current share price is $96. It's fallen from a high of $200 to $96. Share price has halved. The reason I'm interested in this company is simply their streaming platform, Disney Plus. But when you look at the market capitalization, 175 billion, price earnings ratio 65. The reason that is so low is if you look at the profit, the last year was 2 billion. The previous year to that was negative 2.9 billion. But if you go pre-COVID, this company was producing over $10 billion of profit per year. So if you take that into account, $10 billion of profit per year, mark up 175, that would mean the price earnings ratio of this company is less than 20. So that's the one reason I'm interested in this company, is I do believe they will get back to pre-COVID levels when it comes to profit. I think because of their streaming service, which I think has a potential at this point in time, just a potential to overtake Netflix, I'd say in 5 years' time, as the most successful, the highest subscribing base streaming platform in the world, just because of the quality of products I think that is coming out of Disney Plus at this point in time. So that's the one reason I have Disney Plus on my watch list. Another company that I'm following quite closely. Now, I don't know Zillow Group too much, but I've always been told this is the American version of REA Group. But when you look at the share price performance, share price has fallen from $210 to $33.67. If you look at the financial performance, compare it to REA Group, this is not REA Group in any sense. Maybe it has something to do with management. One of the reasons I'm interested in Zillow Group is the share price is moving towards all-time lows, but at least a 5 to 6 year lows. If the share price falls below about $25, current share price is $33.67. We might see that all-time low being breached. Nice growth in revenue. So look at the annual revenue, really good growth in revenue from $1 billion to $8 billion, but the company has not been profitable during that time period. That is my main concern about a lot of tech companies in America. They're not concerned with profitability. They're all concerned with growing revenue. And I think the mindsets of a lot of management need to change, because profit, cash flow is the most important thing. Those are real companies. So even though I would consider Zillow and other tech companies to be real companies, I just think the focus needs to change. They need to be more focused on creating cash flow and profit. And I think if they did that, or if they were doing that, we might see recovery in some of these companies' share price. Next company I want to look at is Under Armour. The reason I like this company is simply because the clothes I wear. The market doesn't like it. The management has not been performing. Share price is at historical, maybe not historical lows, but the last time share price was around this low was during the COVID-19 financial panic. And then before that, it was way back in 2011. You can see the share price has fallen from a high of $52, which was reached in 2015, to a current share price of $8.50. Even over the past few months, well, since the start of we'll say since November last year, share price of this company has fallen from $27 to $8.50. Current market cap $3.7 billion, PE ratio 17. But when you look at the revenue, this does not come onto my checklist simply because revenue has not grown. Well, it's grown slowly from $5 billion to $5.7 billion. We did see a fairly big drop in 2020 because of COVID-19. So the main concern is just the lack of growth in revenue, or very small growth in revenue. And the margins are fairly small in this company. So only profit of $360 million in the last year. And if you look at quarterly data, we have seen a significant drop, a pretty good drop in revenue over the past few quarters. But just where the value or the price is right now is the only reason I'm interested in Under Armour, apart from me wearing a lot of their sporting clothes, their running clothes. Now, a company I'm definitely interested in is Unity Group. So this listed on the Nasdaq in late 2020. And I just like what this company does. Share price has fallen from $210 to $37.50. If you don't know what this company does, just tell you. They develop video gaming software, provide software solutions to create, run, and monetize interactive real-time 2D and 3D content for mobile phones, tablets, PCs, consoles, and augmented and virtual reality devices. So a lot of buzzwords in there, a lot of potential growth in the future for this company. Company is not profitable. So let's have a look at some of the financials. Revenue has grown from $380 million to $1.1 billion, so good growth in revenue. But in the last financial year, the company lost $532 million. More than likely, a lot of that loss was because of share-based compensation. A lot of tech companies in America love their share-based compensation. I absolutely hate it. And I think if they just had some other ways to compensate their staff, that would be much better. I really don't like share-based compensation, but for some reason, tech companies love it. Ark Innovation. This is Kathy Wood's, one of her funds. This could be interesting times. So look at that massive rise in the share price of Ark Innovation from the bottoms of COVID-19. We went from $35 all the way up to a high of $160, and it's fallen all the way back to $35. It's bounced off the pre-COVID lows or the COVID-19 lows. You just see it bounce off it quite well on 2 occasions. We also have seen a rise in volume. So potentially we might be seeing the lows in Ark Innovation. If we are seeing the lows in the Ark Innovation, this could be a turning point for these beaten down tech companies on the Nasdaq. Remains to be seen. I think the lows could be reached if we start to see the central bank in America, the Fed, become a little bit more concerned about rising interest rates and how that's really going to negatively affect the economy. And they might be more concerned once we start to see unemployment rise, once we start to see job postings decrease, because the Fed is concerned about 2 things, inflation and also employment. And right now they have full employment or very low unemployment. So they're focused mostly on decreasing inflation. And if they see rising unemployment, they're going to face a tricky scenario. Will they be focused on inflation if that's not falling, or will they focus their policies on getting unemployment back down? So I think there's a lot to play when it comes to the economies of the world, because we are entering a stage where I don't think many people know what's going to happen. And they're just going to shoot for the fence in some of their policies. Some of those policies are not going to work. Some of the policies will work. Remains to be seen. We could be heading for a very difficult period. That is definitely in the pipeline. Ford. I've already mentioned that I do think there is potential. Ford, General Motors, Volkswagen will overtake Tesla as the biggest producers of electric vehicles. We did see that thematic sort of play out once we were into the later period of 2020 into 2021. We saw the share price of Ford increase from about $4 or just above $4 to $25. But the share price has pulled back significantly in the past, or since the start of the calendar year. In fact, the share price of Ford has more than halved from $25 to $11. But if we actually go back even further, you can see Ford was in a long-term downtrend from 2014 all the way through to the COVID-19 low. So not a really well-liked company. When you look at the valuation, dividend yield of 3.5, price to earnings ratio 3.9. So the market definitely is thinking that last year was the best year, and we're going to see the financial state of this company actually fall away. $17.9 billion of profit in the most recent year. When you go back through time, this company did have profit of $7.7 billion in 2017, then $3.7 billion in 2018. And we have seen falling revenue, but revenue did rise in financial year 21 compared to financial year 20. Remains to be seen what's going to happen with revenue for this company moving forward. But if they do have success in the electric vehicles, maybe we have seen the bottom in Ford Motors, and that bottom was $4. I was going to look at General Motors, but I won't focus on that. Another high quality company is Costco. Now, when I'm doing my checklist, I'm thinking one of the things in my checklist should be gross profit margins. But Costco has very low profit margins or gross profit margins, and that's their moat. So that's the advantage they have over, say, Walmart or those other supermarket type companies, is they have higher margins at Costco. And the reason why Costco has been successful is they've been able to use those really low gross margins and to become successful. This is a real high quality company. So the way to view high quality companies is you got to look at the whole picture. Just don't focus on one little financial metric. And you could make that mistake with Costco if you look at their margins. Anyway, share price has fallen from $600 to $400.20, but the trend is still up when you look at the weekly chart. When you look at the daily chart, the trend has turned around in the last month or so. Really good growth in revenue over the past 5 years. Revenue's grown from $129 billion to $195 billion. You can just see profit in the past year was only $5 billion. So really low profit margins, 2.56%. Current market cap is $215 billion. Price earnings ratio 38. So there is a lot of premium priced into Costco right now. And that's the main reason I'd probably be staying clear of this company, even though I do think it's high quality. Square or Block, they were called Square and then they changed the name to Block, but they've kept the ticker code SQ. Reason I'm showing this is because a lot of Afterpay shareholders are now in Block. Share price down, without doubt. Share price has fallen from $290 to $63.90. And not only that, share price is now in between those two levels. So I'm looking at two levels again, pre-COVID highs and COVID-19 lows. Share price is right in the middle at $63.90. The COVID-19 lows for Square or Block was about $40. Still a little bit to go until we see the share price of this company hit that level. This is not a profitable company. I don't think it's a profitable company. Market $37 billion in the last year, slightly profitable. Revenue of $17.7 billion, $166 million of profit. So company has been profitable but by a small amount. If you look at profit margins, 0.94% profit margins. If you look at cash flow, I would suggest that the operating cash flow is a little bit higher, $847 million of operating cash flow in the past year. So again, I think the market is pricing in that this company will become highly profitable in the future. But I think large portions of the market aren't uncertain about that right now. Company I am interested in is Zoom. And I think there is potential this company has hit a bottom. And when you look at the weekly chart, you can just see how this was COVID-19 darling. You can see share price rose from about $60 to a high of $580 during 2020 because of COVID-19. You see no COVID-19 blip in the share price of Zoom. And then since October of 2020, and what happened in October 2020? And this is also when Kogan fell off a cliff as well. This is when the announcements of vaccines became known, and that was the top in a lot of these COVID-19 stories like Zoom. But Zoom share price has fallen from a high. What was a high here? Almost $600. The high was $588.84. It's fallen from that level all the way back to $80. But when we look at the daily chart, we're starting to see some movement. So the share price low was $80 and about $80 or so, which was the 12th of May 2022. They released some good news. I think it was the quarterly data, maybe something. And you can actually see that in the quarterly data. Well, they released something positive that has turned the market around. And I think this could be a period of time where we start to see Zoom Video's share price start consolidate or go sideways. So this is definitely a company I'm starting to follow a little bit more closely because of what's happening in the share price over the past 2 months. So Zoom is on my watch list. I do use Zoom. I do like their products. This company has grown over the past few years because of COVID-19. Let's go to Berkshire Hathaway. I'm really upset with myself because I nearly bought Berkshire Hathaway when it was $200. I think it was around about July or August of last year. You can see that little share price got down to about $150 during COVID-19 lows. Then we saw a recovery in the share price. The share price went from 200 to a high of $360. Now, I am unsure about the future of Berkshire Hathaway because so many investors have bought into this company because of Buffett and Munger, and those two investors, I think Munger might be nearly 100 right now. So I'm a little bit concerned that when those two investors pass away, what effect that's going to have on the Berkshire Hathaway share price. So that is one concern I do have moving forward. Share price has moved into a downtrend right now. But this is definitely a company I do have on my watch list simply because of the history it has. But again, there are a few concerns around this company. Next company I want to look at is Spotify. I have no intentions of buying this company. This is just, I just want to have it on here because I have heard a lot of different opinions about this company. So a lot of people think this is not an investable company. But the main reason I just want to show you right now is because if you take the low, so that's the previous low we saw back in 2019 or late 2018. Remember late 2018, we did see a bit of a squeeze in the equity markets because at that point in time, the Fed was talking about raising interest rates. The market really didn't want to hear the Fed raising interest rates. And that's why we saw a bit of a correction in the market. And that's when Spotify reached a share price of around, the low was $103.29. Share price of Spotify has fallen below those lows. So right now, Spotify is at an all-time lows. Share price $97.52. Markup $18.5 billion. A nice growth in revenue. So revenue has grown from $4.6 billion to $11.43 billion. The company has not been profitable. So that's one thing they have to show me is, can you translate the growth in revenue to profitability? And I just don't know if I like their business model, simply because I don't think they have much of a moat at this point in time. And that's my main concern with Spotify is the lack of a moat. Like they hired that Joe Rogan, his podcast. So maybe you can only listen to Joe Rogan on the Spotify podcast. So they might be trying to build a bit of a moat there. But to be honest with you, most of the music streaming, I don't think there is much of a moat. In fact, I have seen some artists pulled or want their music pulled from Spotify because of Joe Rogan. So I don't listen to Joe Rogan at all. I don't know what his deal is, why some people have a problem with him, also why some people might like him. Anyway, Atlassian, one of the greatest Australian companies ever, but this is not a profitable company, I don't think. Anyway, Atlassian. Now, probably the best way to talk about Atlassian is that had significant growth in their revenue. So let's have a look at the growth in revenue. It's grown from $620 million in 2017 to $2.1 billion in 2022. So revenue has tripled in 5 years. But when you look at the profit, they were loss-making last year by a fair bit, 696 million. Previous year, loss-making 350. Previous year to that, loss-making 630. I think, again, most of that probably is stock-based compensation. We sort of can confirm that. If we look at cash flow, this company did produce $830 million operating cash flow. So I would say that this company is spending a lot when it comes to stock compensation. Well, not spending a lot, but they are providing a lot of stock compensation. And that goes to, when you do look at stock compensation, that will go to the income statement, but not the cash flow statement. So sometimes you will see these companies lose a lot one year, but have high operating cash flow or even free cash flow. So this company is producing money in operations, but they are still loss-making because of stock-based compensation. Anyway, the reason I want to look at Atlassian, apart from it being an Australian company, and most of the focus on this video is American companies, is the share price has reached, in the past month or so, actually 2 months or so, a really strong support level at $160. And that support level was developed back in 2020 and 2019. And if we look at the daily chart, you can able to see how the share price has bounced off that support level. So it reached it back in May, 12th of May, bounced off it, then tested again during May. So next few weeks, it tested $160 and bounced off it, tested again in June, and we've seen another bounce. So potentially $160 is a really strong support level. Well, not potentially, it is a strong support level for Atlassian right now, and potentially is a good buying price for this company. I would be surprised to see 160 breached on the downside, because there is potential we might see further downside in many of these companies. That's just a potential. I don't know. I don't know the future. Last company I want to look at is Intel Corporation. This company does have a storied history on the markets. If you look at the monthly, let's have a look at the monthly chart. Okay, so I can see how this company really benefited from the tech bubble back in 1999. Share price of this company rose from like $1 all the way to a high of $75. This was like a 75 bagger for any holders over a 6-7 year period. And the share price has not reached those highs, has not reached those tech bubbles highs of what, $75. And the share price has been struggling over the past few months. Share price has in actual fact has dropped from a high of $68 to $36. So it's almost halved. A markup of $148 billion. Price to earnings ratio 6.2. So if you look at the price to earnings ratio in isolation, you might say this company is looking awfully cheap right now. When you look at the profit in the last year, $20 billion. Previous year to that was $21 billion. Previous year to that was $21 billion. Previous year to that, $21 billion. No growth in profit. Revenue is climbing slowly. It's risen from 62 billion to 79 billion. When we look at the quarterly data, profit of $8 billion in the last quarter. So price earnings ratio is 6.2. This could be a cheap play, a value play right now. So that's the main reason I have an interest in Intel. I wouldn't say it's a high quality company at this point in time. A quality company maybe, simply because revenue is climbing slow rate, profit is falling at a slow rate. So at this point in time, I think that price earnings ratio 6.22. This company needs a little bit more looking into, simply because there might be some value. That's all I have for this technical update. 4th of July edition for the United States and Nasdaq. There's Dow Jones and the S&P 500. Looked at a fair few individual companies as well. Many of these companies are on my watch list right now. I'm looking at a potential buy-in in the next few months, particularly if we see further downside. I will be becoming more interested in taking positions in these high quality companies. If you do have any questions about any companies I have mentioned in this video, if you disagree with me on any of these companies in the video, I'd love to hear your opinion. I love to hear different opinions than my own, because that's how we learn and that's how we grow to become better investors in the long term. So leave in the comment section of this video. Otherwise, I'm not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.